I had started investing when I was 11. I just dithered away until when I was 7 and 8 and 9. So unfortunately, I didn't get started until I was 11. But I bought my first stock when I was 11, and then I experimented with a whole bunch of things, the timing of stocks and charting and doing all these crazy things. It was a lot of fun. Profitless, but a lot of fun. And I did that until I was 19. And I read all the books on investing in the public library, and I ate it up. It was fascinating to me, but I had no framework. I was just searching for something. I was hoping that little things on a chart would tell me something about what a stock was going to do. It was kind of crazy, but everybody else was doing it, so I figured I'd do it too. Sometimes you'd turn the chart upside down, it still wouldn't help. Then in 1949, I read The Intelligent Investor by Ben Graham. I'd never heard of him up till then. And there are really only 2 chapters in that book that are the key to it. But they set my philosophical framework for investing in 3 ways.
Warren Buffett, How to Invest for Beginners, 3 Simple Rules. Imagine being just 11 years old and making your first stock purchase. That's exactly how Warren Buffett, one of the most successful investors of all time, started his journey. He didn't hit the ground running, though. Like many beginners, he made his fair share of mistakes. From dabbling in market timing to following the ups and downs of ticker symbols, Buffett spent years experimenting without much success. It wasn't until he came across Benjamin Graham's book, The Intelligent Investor, that everything changed. Suddenly, investing wasn't just about numbers and charts. It was about owning a piece of a real, functioning business. This revelation set Buffett on the path to becoming the financial legend we know today. But what exactly did Buffett learn that turned him into such a powerhouse in the investing world? That's what we're diving into today. In this video, we'll break down 3 simple yet profoundly effective rules that Warren Buffett has followed throughout his career. These aren't just rules for seasoned investors. They're guidelines that anyone can apply, whether you're just starting out or looking to refine your strategy. Before we dive in, here's something to think about. What if you could see the stock market not as a chaotic battlefield of prices, but as a place where careful, patient decisions could lead to lasting wealth? Stick around, because we're about to reveal how Buffett does exactly that. If you're ready to learn these game-changing principles, don't forget to like this video, share it with others who might benefit, and subscribe to the channel. Trust me, you won't want to miss any part of what's coming next. Rule 1. A stock is part of a business. When you hear the word stock, what comes to mind? Maybe it's a flashing ticker symbol or the ups and downs of market prices. But Warren Buffett views stocks very differently. For him, each stock isn't just a random piece of paper or a line on a chart. It's a slice of an actual business, complete with its own products, employees, and challenges. Imagine walking into your local grocery store and deciding to buy it. You'd want to know everything about it, how it makes money, who its competitors are, and what its long-term prospects look like. That's exactly how Buffett approaches investing. He doesn't just buy stocks, he buys into businesses. Learning from Benjamin Graham. Buffett learned this crucial lesson early on in his career thanks to his mentor, Benjamin Graham. Graham taught him to see beyond the daily market fluctuations and focus on the underlying value of the business. Buffett took this advice to heart and has used it as the foundation of his investment strategy ever since. For example, when he bought shares of Coca-Cola in 1988, he wasn't just looking at the stock price. He saw a brand with a deep emotional connection to consumers worldwide, a business with strong profitability and global reach. This mindset allowed him to hold on to Coca-Cola for decades, reaping the benefits of its consistent growth. Doing your homework. But what does it mean for you as an investor? It means doing your homework. Before you buy a stock, you need to understand the company behind it. What does it do? How does it make money? Who are its competitors? What challenges does it face? And, most importantly, does it have a competitive advantage that will allow it to succeed over the long term? These are the kinds of questions Buffett asks before making any investment decision. And here's the thing. This approach isn't just for billionaires. Anyone can use it to make smarter, more informed investment decisions. A perspective shift. Now, picture this. You've just discovered a company you believe in, one that aligns with your values and has a solid business model. But before you hit that buy button, take a step back and ask yourself, do I really understand this business? Would I be comfortable owning it for the next 10 years, regardless of what the market does? If the answer is yes, you're on the right track. But if there's any hesitation, it's time to dig deeper. This focus on understanding the business, not just the stock, is what sets successful investors like Buffett apart from the rest. What comes next? As we move forward, think about how this principle applies to your own investment journey. Do you view stocks as mere numbers on a screen or as pieces of real businesses with real potential? This perspective shift is crucial, and it leads us to another vital aspect of Buffett's philosophy: dealing with the unpredictable nature of the market. How do you stay calm and rational when the market seems to be losing its mind? The answer lies in a concept Buffett calls Mr. Market, which we'll explore in the next section. This approach isn't just about picking stocks. It's about changing the way you think about investing. Rule 2. Mr. Market is your partner, not your master. Imagine you have a business partner who shows up at your door every morning, eager to buy your stake in your business or sell you his. But here's the catch. This partner, Mr. Market, is highly emotional. Some days, he's optimistic and willing to pay top dollar for your share. Other days, he's in a slump and offers to sell you his share for a bargain. Warren Buffett introduces Mr. Market as a way to personify the stock market's mood swings. The key lesson here is not to let Mr. Market's emotions dictate your investment decisions. Instead, you should view him as a tool to take advantage of, not someone whose every whim you should follow. Mr. Market's mood swings, a double-edged sword. Mr. Market is notoriously unpredictable. On one hand, he can be excessively exuberant, pushing prices far above a company's intrinsic value. On the other, he can be depressingly pessimistic, driving prices well below what a business is truly worth. Buffett emphasizes that it's crucial to remain rational and not be swayed by Mr. Market's mood swings. For instance, during the dot-com bubble in the late 1990s, many investors were swept up in the euphoria, paying astronomical prices for tech stocks. Buffett, however, stayed on the sidelines, recognizing that Mr. Market was overenthusiastic and that the prices far exceeded the actual value of the businesses. When the bubble burst, those who followed Mr. Market blindly suffered significant losses. But what happens when Mr. Market's mood turns sour? Consider the 2008 financial crisis. Mr. Market was in a deep depression and stock prices plummeted across the board. While many investors panicked and sold their shares at a loss, Buffett saw this as an opportunity. He used Mr. Market's irrational fear to buy shares of solid companies at bargain prices, setting himself up for substantial gains when the market eventually recovered. This is the essence of using Mr. Market to your advantage. Buy when he's overly pessimistic and sell when he's irrationally exuberant. Staying rational, how to use Mr. Market to your advantage. So, how can you apply this principle in your own investing? Start by reminding yourself that Mr. Market's daily price offers are there to serve you, not to instruct you. Just because a stock's price has dropped doesn't mean the business is failing. It might simply be an opportunity to buy at a discount. Conversely, just because a stock's price is rising doesn't mean it's time to jump in. It could be that Mr. Market is overvaluing the business. Your goal is to stay focused on the underlying value of the business and make decisions based on that, not on the whims of the market. One practical way to implement this is by setting a target price for the stocks you're interested in, based on your assessment of their intrinsic value. When Mr. Market offers you a price below that target, it's time to consider buying. If he offers a price above it, you might want to hold off or even sell. This disciplined approach helps you avoid the emotional roller coaster that many investors experience when they try to time the market. Rule 3. The margin of safety. Imagine you're about to cross a bridge that has a sign stating it can hold up to 10,000 pounds. Your truck weighs 9,800 pounds. Would you risk crossing that bridge? Most people wouldn't, and that's exactly how Warren Buffett views investing. The concept of a margin of safety is like that extra cushion you need to feel secure in your investments. It's about ensuring that even if things don't go exactly as planned, your financial health isn't put at risk. This principle, which Buffett learned from his mentor Benjamin Graham, is one of the cornerstones of value investing. The idea is simple. Invest in a stock at a price that is significantly lower than its intrinsic value. This way, even if your analysis is slightly off or the market takes a downturn, your investment remains relatively safe. Real-life applications. Buffett's successes and lessons. Let's take a walk through some of Warren Buffett's most famous investments to see the margin of safety in action. One of his notable investments was in the Washington Post Company in the 1970s. At the time, the company was going through some rough patches, and its stock was trading at a price well below its intrinsic value. However, Buffett recognized the company's strong assets and solid management. By buying the stock at a significant discount, he built in a margin of safety. Even if the company faced further challenges, he knew that the gap between the stock price and its true value would protect his investment. Over time, the Washington Post turned around and Buffett's investment multiplied many times over. But Buffett hasn't always hit the mark. For instance, his investment in Dexter Shoe Company in 1993 serves as a cautionary tale. Buffett bought the company without a sufficient margin of safety, misjudging its ability to withstand competition from low-cost imports. The investment turned out to be a disaster, costing Berkshire Hathaway hundreds of millions of dollars. This mistake reinforced Buffett's belief in the importance of always having a margin of safety, no matter how promising an investment might seem on the surface. How to calculate the margin of safety. So, how can you apply this principle to your own investments? Start by determining the intrinsic value of the stock you're interested in. This involves analyzing the company's financials, future earnings potential, and overall market conditions. Once you have a good estimate of the intrinsic value, compare it to the current market price. The difference between these two figures is your margin of safety. For instance, if you calculate a company's intrinsic value to be $100 per share, but the market price is $70, your margin of safety is 30%. This cushion protects you from unexpected downturns or errors in your valuation, giving you more confidence in your investment decision. But how do you determine the intrinsic value? While it's a complex process that involves various financial metrics, the key is to look for companies with stable earnings, strong management, and a durable competitive advantage. You don't have to get the value exactly right. The margin of safety is there to protect you in case your estimates are off. This approach is not about finding the lowest price stocks, but about finding quality stocks at prices that offer a significant buffer. The power of patience and discipline. Investing with a margin of safety requires patience and discipline, qualities that are often in short supply, especially in a fast-paced market environment. It's easy to get caught up in the excitement when prices are rising, but that's precisely when it's most important to stick to your principles. Buffett is famous for his ability to wait for the right opportunity, even if it means sitting on cash for years. He once said, "The stock market is designed to transfer money from the active to the patient." By focusing on investments with a solid margin of safety, you can ensure that you're on the right side of that equation. This patience also involves resisting the urge to jump into investments that seem too good to be true. Remember, the margin of safety isn't just about the price. It's about understanding the business and ensuring that it has a strong foundation. If a stock looks cheap, but the business is struggling or the industry is in decline, it might not offer the margin of safety you need. Always do your due diligence and make sure that the company's fundamentals align with your investment criteria. Bridging to long-term success. Now that we've explored the margin of safety, it's clear that this principle is essential for building a resilient investment portfolio. But how do you tie it all together with the other rules we've discussed? The answer lies in understanding that these rules are interconnected. By viewing stocks as parts of businesses, using Mr. Market to your advantage, and ensuring a margin of safety in every investment, you're laying the groundwork for long-term success. How to apply these rules in your own investing. Step 1. Understand the business behind the stock. Imagine you're walking down the aisles of your favorite grocery store. You know the products, you've interacted with the employees, and you've seen how the business operates firsthand. Now, what if I told you that this intimate knowledge is exactly what you need to bring to the stock market? Warren Buffett's first rule, viewing a stock as part of a business, requires you to dive deep into understanding the companies you're investing in. Before you buy a single share, take the time to study the business thoroughly. What are its products or services? Who are its competitors? How does it generate revenue? And what are the risks it faces? For example, if you're considering investing in a technology company, start by asking yourself if you truly understand the tech it's developing. Do you know the market it operates in, and are you aware of the potential for future growth? This is where many investors falter. They get excited about the stock price or market hype without fully grasping what the company actually does. Buffett advises sticking to your circle of competence, meaning you should only invest in businesses you understand. This knowledge gives you a significant edge, allowing you to make informed decisions rather than gambling on market trends. Step 2. Use Mr. Market to your advantage. Now, let's talk about Mr. Market, your emotional business partner who offers to buy or sell shares every day. The key to applying Buffett's second rule is to remember that Mr. Market's offers are there to serve you, not to guide you. Just because a stock's price drops doesn't mean the business is failing. It might simply be an opportunity to buy at a discount. Conversely, a rising stock price doesn't necessarily mean it's time to jump in. Mr. Market might be overvaluing the business. To use Mr. Market to your advantage, you need to stay rational and avoid getting swept up in the emotions of the market. Set a target price based on your valuation of the company, and stick to it. For instance, if you've determined that a company's intrinsic value is $100 per share, but the market price is $70, consider it a potential buying opportunity. On the other hand, if the price soars to $150 due to hype, it might be wise to hold off or even sell if you already own shares. This disciplined approach will help you avoid the emotional roller coaster that many investors experience when they try to time the market. Step 3. Ensure a margin of safety. The margin of safety is like your financial safety net, allowing you to invest with confidence even when the future is uncertain. But how do you ensure a margin of safety in your investments? Start by calculating the intrinsic value of the stock based on the company's financials, future earnings potential, and market conditions. Then, compare this value to the current market price. The difference between these two figures is your margin of safety. For example, let's say you're interested in a company whose intrinsic value you estimate to be $50 per share. If the current market price is $35, you have a margin of safety of 30%. This cushion protects you from unexpected downturns or errors in your analysis, giving you peace of mind in your investment decisions. Remember, the margin of safety isn't about finding the lowest priced stocks. It's about finding quality stocks at prices that offer a significant buffer. This principle is particularly important during market volatility when prices can swing dramatically based on external factors. Step 4. Practice patience and discipline. Investing isn't a get-rich-quick scheme. It's about building wealth steadily over time. Applying these principles requires patience and discipline, qualities that are often in short supply in today's fast-paced world. Buffett himself is known for his ability to wait for the right opportunities, sometimes sitting on cash for years before making a move. This long-term perspective is crucial to successful investing. To practice patience and discipline, resist the temptation to chase after every hot stock tip or market trend. Instead, focus on the fundamentals of the businesses you're investing in and be prepared to hold your investments for the long term. This might mean waiting for years before you see significant returns, but as Buffett often says, the stock market is designed to transfer money from the active to the patient. By sticking to your investment strategy and maintaining a long-term outlook, you can weather the ups and downs of the market and come out ahead. Building a resilient portfolio. Now that you understand how to apply these rules, the next step is to build a resilient investment portfolio. Start by selecting companies that align with your understanding and values. Use Mr. Market's mood swings to your advantage, buying when prices are low and selling when they're high. Always ensure a margin of safety in your investments to protect yourself from the unknown, and practice patience and discipline to stay focused on your long-term goals. As you build your portfolio, remember that these rules are interconnected. Each one reinforces the others, creating a strong foundation for your investment strategy. By applying these principles consistently, you can develop a portfolio that not only withstands market volatility, but also grows steadily over time. Keep in mind that the most successful investors are those who combine knowledge with discipline, patience, and a healthy respect for the risks involved. As you step forward on your investment journey, the power to build your financial future lies in your hands. By embracing the principles we've explored, understanding businesses, staying rational in the face of market swings, and safeguarding your investments with a margin of safety, you're not just investing in stocks, you're investing in your future, in your dreams. Before you go, I encourage you to take one final step. Stay connected with this community. If you found value in these insights, don't forget to like this video, share it with others who might benefit, and subscribe to Economy Explorer for more content that empowers you to take control of your financial future.